Jonathan, do you know what's going on in the market right now?
I do, and I want to share it with you.
No, you're supposed to say, I don't know. But we do know who it is. I know, totally. Yes! Well, everybody, we think we know what we're talking about, but at the end of the day, that's why we have Hugh here. Welcome to the newest episode of Hugh Knows, because Jonathan and I, we may or may not. But on this episode, we're breaking down what's going on in the market, and that's national interest rates, what's impacting those, but then also, more importantly, for all of our Houston realtors and our clients in the Houston area, we're talking about what's going on in the Houston market specifically.
H-Town!
That's right. So before we go any further, real quick, as we always do, we just want to mention that these are just our personal views. We're not here to give you investment advice, and we're not telling you the views of our parent company, Network Funding. If you want to know that, you can reach out to corporate and ask for a guy named Michael David. So,
Well done.
Yeah. So let's jump into it. Hugh, what are we looking at today?
Yeah, so the first thing we're going to be looking at is interest rates. Obviously, those are always interesting, so we'll be checking out to see what's going on with those. And then next, we're going to give you an update on inflation, what that's sort of implying for the market. Employment, we'll cover that as well. And we're going to jump into a segment talking about what's best for home affordability, price versus rate. So we're gonna discuss that, and then we're gonna look into the Houston market, our forecast for the rest of the year for the Houston market, how we expect prices and sales to go for that. We're gonna look at inventory, and then we're gonna end off looking at, in honor of Houston Restaurant Week / month, our favorite restaurants. So,
Fantastic.
yeah, so let's jump into it. So first, interest rates are interesting. Okay, so here on the slide, what we're basically showing is the 30-year fixed mortgage rate from Mortgage News Daily, looking from August 16th, 2022 to yesterday. Ooh. And it's not looking great out there, guys. Got to be honest. It's not it kind of stinks. So what's been going on? The most recent thing was that the U.S. debt has been downgraded, so that's really driven up the 10-year Treasury yield because of that, and it has also impacted 30-year rates. They were down. The U.S. debt was downgraded because of the debt ceiling negotiations, however you want to term those. And so you can see on the screen that basically leading up to when we were supposed to, run out of money, and they were talking, the market really was pricing in some extra risk. So you saw rates rise, and they really kind of haven't fallen since then. And most recently, they've started to go back up. So we were in, the mid sevens now as far as interest rates. So back to November 2022 levels.
Yeah.
Yeah, I mean, actually, you look back, we're down to 2000 levels, or up to 2000 levels. So
yeah, highest interest rates in 22 years.
23 years. Yeah, 23 years. So they're up there. But on the debt ceiling, the way I look at it, I was listening to a podcast the other day, is that of all the tax revenue we generate as a country, like all the money we bring in, 30% is going towards our interest payments as a country. And you think as a lender, we're always looking at someone's debt to income ratio. Right. And we lend up to 40, 45, 50% depending on programs. But you think about a country, 30% of its income going towards interest payments.
Right.
That is bananas.
Yep.
And so if I'm a country that's borrowing money or investing in bonds or treasuries, I'm like, I don't know how good I feel about the U.S. economy.
Yeah. And
downgrade.
To piggyback on that, essentially what Congress did is they imagined that our debt is a credit card. They just reached out and asked to increase their credit limit, right?
Yeah. 10K to 20K.
As a lender, when someone's doing that, when they're increasing their credit limit, that means that all of a sudden they became riskier, right? Because now it's like, why are they increasing that debt limit? Are they worried that they're not going to be able to make their payments? Right. Now I'm worried they're not going to be able to make their payments. And so as investors, that's literally what is happening. People are investing in buying U.S. debt, and then now all of a sudden it's like, we're not sure that this is going to get paid back. Or what happens? Do they keep kicking the can down the road, keep expanding the debt? It's politics, but it has real practical implications for all of us. Whether you're in the real estate industry or you're just looking to finance a house, the debt ceiling increase hurt you.
Yep, absolutely.
Plain and simple.
Yep.
Yeah. So
or that whole debate and the uncertainty around it is not what markets want to see.
Right.
So yeah. So talking about markets, we're going to jump into this next slide. And again, we like showing this slide. So basically, it shows what the market's expecting the Fed to do, and that's in the green line versus what the Fed has said it's going to do in its latest dot plot, as they call it. And so basically, the Fed is saying we're not going to cut rates for the rest of the year. And the market essentially agrees with them. But there is, probably 35% of the market that does think that we might see an increase in rates this year. The majority of the market is still saying that, no, we're not going to see increase rates for the rest of the year. So that is some positive news. But, we continue to watch this pretty closely because obviously the market can change its view if we get some new information out or if there's concerning data, for instance, that pops up.
For sure.
Yeah, spot on. So the Fed hiked in July, no Fed meeting in August, and then we have September and November.
Yeah.
So there's 2 more Fed meetings.
So a lot of people think that maybe in November we'll see a Fed hike. Again, it's a minority, but it's a significant minority, 30, 40% of the market thinking that. So, yeah. And of course, the Fed is looking at inflation. So we're going to jump into that segment here, looking at the inflation situation. So on the chart,
I like
display
that inflation.
the inflation situation.
Like
yeah, we got that. I'm a poet and I didn't know it. So here I'm showing CPI, the core, and the top line number back to 2015, so you can see how it's sort of evolved. The 2% mark, that's where the Fed wants inflation, so we're still way above that. Obviously, we've made some pretty significant progress. I think that the July report showed the top line number increase. So you can see that in the light red line, that it kind of increased in July. That's the latest reading, but core continues to fall, and there's reasons to think that that's going to continue to fall because of mainly shelter. Shelter is the main reason why we saw an increase in the top line number in July, but we know that there's this lagged effect the way they calculate shelter, and we're already starting to see real rents fall precipitously, really. So we should start to see that in the data over the next few months. So that was good. So the market was sort of neutral on that news, but really is the debt ceiling, the debt ceiling and the downgrade from that has been driving rates up, even though we've been making progress on the inflation situation. So hopefully the Fed is confident in that. There have been some comments from Federal Reserve members saying that, hey, we don't want to overdo the interest rate increases or keep it high for too long because we've made a lot of progress in inflation. And you can see that on the chart with the 2 lines, both core and the overall CPI coming lower.
Yeah. I mean, as lenders, we're happy to see this, you know. So this is what you want to see. You want to see inflation coming back down. We're still fairly far north of the Fed's 2% target. So it's like it's coming down, but we're not there yet.
Yeah, like the overall is at 3.3%, but the core is at 4.7%, and they really want that core down to around 2%. So it has a way to go before we get there, but we're still making good progress.
Yeah, this is, to me, I think the strongest case for why there's probably still going to be another Fed hike.
Yeah.
In my personal opinion. It's like, we're not there yet. They're going to keep giving us what they see is working. It's like, this is working, but we're not there. We're going to keep at it.
Yeah, and I mean, and on this next slide, we're going to show the employment situation. This is the main thing that the Fed is considering as they look at inflation. They're looking at what really is the price that we're paying for service labor. Mm-hmm. So this is showing the job openings versus the unemployed in the United States, and you can see, back in time, there was more job openings before COVID, and then the U.S. unemployment rate and number of unemployed spiked during COVID. So you can see that, and you can see the gray areas, the difference between the two. And then now, after the COVID era, we've moved to this sort of structural, let's just call it, gap between how many job openings there are and how many people are looking for jobs. And so that's keeping upward pressure on the price of labor.
Yeah. So I didn't get to hit on this, but there's 2 big things going on with inflation right now. For everybody watching, we look at CPI. That's the Consumer Pricing Index. So we're talking about the consumer.
Right.
Well, what's going on with the consumer right now? Credit card debt is at an all-time high. I shared with our team the other day that credit card delinquencies now are at a 13-year high. So now people are getting defaulted, getting sent to collections on their credit cards. And then what happens October 1st?
Student loans.
Student loan payments. So guess who's getting squeezed right now? The consumer.
Right.
And so guess what they're going to do? Buy less goods and hopefully buy less services.
Right.
So I think hopefully the Fed waits in September, and then November they'll have September and October's inflation data. So hopefully by November they'd be like, man, student loans getting turned back on, and these credit card delinquencies are really crushing the consumer, and hopefully.
And you have like big
we see
banks
it,
like
a
Goldman
nosedive.
Sachs saying we're not going to see another increase, and then you have other banks like the Bank of America said we will see an increase. So there's a difference of opinion. I'd say it's more weighted to no increase, and I hope that's the case. But obviously, as Austin said, there's still a chance given where inflation is. So
Yeah.
My holdup is just on core. So like
core needs to come lower.
I think actual inflation is falling fast, but I think
that core number
it's going to be hung up on core and the job openings, and it's just this mixed bag, like you're saying, Jonathan. There's so many factors playing into it.
Right.
Yeah, and I think the job piece, right? You got boomers that are like, I'm just gonna retire.
Right. No, you had people kind of drop out of the labor force permanently when COVID hit.
I think the Fed could get to 2% inflation. I think mortgage rates come down, and I still think we're gonna see low unemployment. We're gonna see pressure on wages. Like for a time, you shared something with me last night that kind of reinforced that as well.
Yep.
I just think there's just less
which is actually good if we can see inflation come down, meaning interest rates come down, but people remain employed. That's good for the real estate industry for sure.
Yeah, 100%. We need people with jobs, making money, and able to buy.
Absolutely, 100%. So, keeping on that topic, but sort of looking at assessing the affordability price versus rate. This
is like Elon versus Zuckerberg right now. Like getting the ring.
That's the price versus the rate.
Who's gonna fight? Sales price or interest rate?
Yeah,
Which one moves your affordability the most?
Yeah.
Let's talk.
So basically, what I'm showing is. On display are the principal and interest payments for a mortgage at different prices. And you can see the prices on the left-hand side, and then at different interest rates. And the increments are proportional. So you see a 5% increase in price as you go down, and then a 5% increase on the interest rate as you go up. So basically, what this is saying is that a increase in price is going to hurt you worse than an increase in your interest rate, and vice versa. A decrease in price is going to help you more than a decrease in your interest rate. And so I think that that's important to keep in mind, particularly as we enter a seasonal lull in the real estate industry, and with the view that interest rates are probably not going to fall in the near term, at least over the next few months, because of the inflation situation.
That's right.
Any thoughts, guys?
Yeah, I mean, you can just pick a scenario on this chart to make the case. Let's just say interest rates fall around 1%, and you're looking at that $325,000 purchase price, right? So let's say that your scenario right now, you're at 7%. You're looking at paying $19.58 right now, and you're like, oh, but I'm gonna wait until interest rates come down like 1%. That's gonna move my payment down to $17.73. But then you see not so fast. If interest rates come down, prices are going to go up, and they're going to go up more than 5%.
Right.
No question. They are going to launch. There are some analysts that are saying they're going to go up 20%. Yeah. So you can see that, okay, yeah, that's great. That cooled you off, almost $200 in that scenario, but just a 5%, and that's not a 5% decrease in rate. That's a 1%. Yeah, that's a 20% decrease in rate. And then you see, okay, if prices just go up 5%, boom, we're at $18.61. We're buying that house for $342. You're paying more in closing costs. You're going to be paying more in your monthly payment. And
taxes, insurance.
Yeah, you can just pick any scenario on here, and it's overwhelming to see that waiting to buy for cheaper interest rates is going to smoke you
on the
actual payment, because the purchase price is going to run away from you as interest rates come down. And I feel like we're a broken record, but people are either not hearing it or they're not believing it.
I know this is going to sound crazy to everybody, but it's like you want to say to the people that are looking for houses, like, the most important thing when you buy a house is how much you pay for it. As far as like your monthly payment, it's like keep the ball you keep your eye on the ball with regard to that. And then work with people that are going to allow you to get the house for a good price, get it under contract at all. Because it is, given the inventory situation we'll cover in a second, prices are likely to, going to rise next year because the labor market's tight, and the market's already pricing in, interest rates falling. So interest rates are probably going to fall. The market remains tight on inventory. People have jobs. That's just going to push prices up.
Yeah. So if I'm talking to y'all and I'm like, Austin, Hugh, home affordability is most important to me. What's my game plan right now?
Your game plan is you need to buy now. Like if the right house is available, you need to buy now. Because that house the house you buy now will get more affordable. That's the good news, because interest rates will come down. You will be able to refi.
Yep.
And if they don't, thank God you bought now.
Yeah.
Right? Like, so you really have nothing to lose by buying now, but you have everything to lose by waiting. Because as you wait, the affordability is moving away from you. The cost of the home and just the actual purchase price, your cash to close, and then your monthly payment is running away from you, and there's not going to be anything you can do about that. Like, once you buy that house, that is the purchase price. Yep. So as you wait, it's going to become more expensive.
The interest rate can change, the purchase price will never change, and so it's more important to get the house for a good price, or to get it at all.
Right.
Okay, so why do we think that prices are falling in Houston, or home values are falling in Houston? We're going to look at Houston's H2, or the second half of the year view. And what I'm showing on display here on the left, I'm showing historic Houston home prices going back to 2013. You can see this sort of seasonal pattern that emerges. And then on the right, I'm showing 2022, the historical months for 2023 through July, and then our forecast, which is based on historical prices and historical sales volumes. Okay, so we did a multifactorial model to create the forecast, and we have sort of a range of values. But what you can see is there's this very seasonal pattern that after the summer months, really starting in July, you start to see prices decline a lot. So I mean, last year in 2022, they dropped from 335 in June down to almost 300 by the end of the year. So that was probably a bigger decrease than normal. And you can see that we're expecting less of a decrease this year, moving from like 325 down to the low 300s. So it's not as big of a decrease, but you still see this seasonal pattern. There's a lot of reasons for that. People want to move before the school year, don't want to be moving in the summer months. So you start to see sales decrease, but that also means that prices decrease. So you're sort of entering the seasonal lull, like this is a seasonal pattern that happens every year. So again, if you think that interest rates are not going to fall over the next 6 to 9 months, which we think that they're probably, not going to fall much, be around the same rate, and at least until we get inflation under control. But prices are coming down, at least seasonally. This is ties back into, is it better to get for a good price, or to wait to get a good interest rate? I think this is making the case that prices are going to fall, and interest rates, you can refinance later, but get the house under contract for a good price.
Yeah, 100%. It's a smart time to buy. And we're seeing people right now being able to leverage this. Things that are coming back really strong right now are temporary buy downs. We're seeing that on a lot of contracts because people are able to negotiate some premium. Now, inventory is still super tight, and that's not the case with every buyer. We've got buyers that are going $50,000 or more over the list price to win the houses right now. So it depends on the house, it depends on the neighborhood, but we are seeing an increase in people being able to negotiate better seller credits and leverage that for those temporary buy downs to get them into a lower rate.
Right, absolutely. And Austin mentioned inventory. So on this next slide, we're showing and this is from today. So this is the months of inventory from HAR.com, looking at single-family residences and townhouses and condominiums. You can see we're at below 3 months of inventory as of today. That neutral price, where you shouldn't see prices increasing or decreasing, all things equal, is at 4 to 6 months of inventory, and we're well below that. So yes, we have started to see, and this is up actually from earlier in the summer. It was like at 2.4. So we have seen an increase in inventory. It's still pretty tight, but that increase in inventory has, already started to see in the prices, because prices in July were just slightly lower than June, and we expect that to continue at least through October, maybe even November, depending on what the Fed does. Mm-hmm. So yeah.
What we got next?
Houston Restaurant Week. All right, slash month. Yeah, so we wanted to do something a little bit.
I think it's Houston Restaurant Weeks now. I think they finally.
They changed it.
They pluralized
it.
Yeah, that's the proper.
Well, that's good. That would be more accurate. So in honor of that, we asked a few of really just us three, and then one of our other loan officers, Jordan, to tell us what are some favorite restaurant picks. And so these are what they are. So I guess I'll let Austin you talk about your pick, and then we can kind of walk through it.
I almost don't want to talk about my pick because I feel like it's one of Houston's best kept secrets. Obviously, most people have probably heard of Tiny Boxwoods and Tiny's Milk and Cookies, but I share this with all of you in confidence that you will not abuse this. That most people don't realize that Tiny's is one of the best date night spots in the city as far as ambiance, food. Most people think of it as a brunch and lunch place, which it is absolutely that. Keep thinking that. Tell everybody else that that's all that it is. But their dinner is fantastic, whether you're going to Tiny Boxwoods or Tiny's number 5. Fantastic place. We know the owners. They're great people, and it's just a great experience.
Yeah, and fun story. We all met for the first time at Tiny Boxwoods.
That is true.
Yeah,
that is true.
It was a nice, cool evening.
Yeah, it was
sit
a nice
outside.
Yeah, we sat outside. It was beautiful.
Yeah.
All right, so
Unlike
Jonathan,
the weather today.
Jonathan, tell us about your
So Tiny Boxwoods, kind of Montrose area town. I'm a moves over to the Galleria area of town. I love Amalfi in the Galleria. It's awesome. It's one of those places you just sit down and like, what should I eat tonight? And they just bring out a pasta and then bring out something else and bring out something else. And I love that kind of service where you don't have to like figure it all out.
You're just there to experience it.
Just there to hang out, and they just keep bringing you food
Enjoy.
and lots of great wine. So it's such a cool place. It's kind of a hidden gem too.
Yeah, 100%. Love Amalfi. Jordan's pick was BCN Taste and Tradition.
Good one. Best Cottajillos in Houston, I think.
Yeah.
So,
I've never been,
there's
but
a
I hear
bold
it's
statement
amazing.
to throw out there, but when I saw
gin and
BCN,
tonics as well. Those things are massive.
Large, like goblet of gin and tonic.
It is absolutely a
good pick,
fishbowl.
Jordan.
Yeah, so check that one out. And then I'm in the Heights, so I picked Super Rica. This is more just a mainstay, but I love their Campanchana. Rachel and I take Helena there all the time, sit outside and enjoy a margarita. So check some of those out. We're not saying that they're part of Houston Restaurant Week. They probably, some of them probably are. I don't know. I didn't check, but these are restaurants that we like. So yeah.
Regardless of if they're on the list or not, you should
check them out. Yeah, 100%. So
yeah.
Anyway, thanks for tuning in to this episode of Hugh Knows, and we'll see you next time.
Peace.